Welcome to the channel Economy of Tomorrow. Views presented here are my own. They say, don't put all your eggs in the same basket. This should also apply to retirement investment funds, right? But what if all these baskets are actually kept in the same place? That's what today's episode is all about. First, I'll talk about how stocks and bonds rose and fell together over the last 30 years. Second, I'll show you how far fund managers have gotten chasing yields today. Finally, I'll explain why investing in corporate bonds could turn out to be even a bigger disaster than investing in stocks. On this chart, pink line represents S&P 500 stock index, and the blue line is the yield on lowest investment grade corporate bonds. In other words, riskiest bonds that mutual funds are allowed to buy. Mutual funds typically invest 30 to 40% of your money in bonds and keep the majority in stocks. Bond prices and their yield are negatively correlated, which means when yields fall, bond prices rise, and vice versa. As you can see, over the last 30 years, since 1982, as stocks rose, corporate bond yields usually declined, and vice versa, 80% of the time. In other words, prices of stocks and bonds have been rising together most of the time. Notice that the same thing has been happening over the last 3 years. And bond yields fell to the lowest level in 30 years. Of course, mutual and pension funds also buy safer corporate bonds rated AAA by rating agencies. Surely they must be in high demand and rise in value when stock prices decline, right? Wrong. See the next slide. As you see, it's a very similar picture as with low investment grade bonds. Also notice that stocks and these so-called safest corporate bonds have been rising together in the last 3 years. What about junk bonds? Were investors more cautious about these highly speculative investments? See the next slide. This chart shows you the spread between junk bond yields and short-term US Treasury bond yields. As you can see, this spread rose nearly ninefold to 21% during 2007-2008 financial crisis. In case you didn't know, a 21 percentage point rise in yield actually results in more than 80% loss on a 10-year corporate bond. Of course, the yields have since fallen close to the 5% level, despite the fact the risks of mass default remain significant, especially because of the potential Eurozone defaults. So the key question is, what the heck is going on? The answer is simple. Fund managers are increasingly chasing higher yields to improve returns, and thereby driving up the prices of both stocks and risky bonds. This has gotten so extreme that these yields are nowhere near adequate given their riskiness. According to an FT article on 21st of March, junkiest of junk bonds did best since October of last year. These were European junk corporate bonds rated CCC, and they returned more than 21%. If you think about it, such risky bonds are much worse as an investment than stocks, because they can be subject to default and restructuring, while the maximum amount that can be recouped or redeemed is the principal amount. Let me explain it on the next slide. Let's say you invest your money in 2 baskets, one in 100 different stocks and the rest in 100 different bonds of £100 each, respectively. Let's say worst comes to worst, and 50% of the companies you invest in go bust, and 50% of bond issuers default. While your immediate losses could be similar on both baskets, your remaining stocks have upside potential over time, while your remaining bonds can only be redeemed to their face values. This means that likelihood of recouping your whole investment in bonds is zero, even after 50 years. Obviously, there are smart guys who claim that risks can be hedged using financial derivatives. But behold, these derivatives only work in good times. In bad times, they have already proven to only exacerbate losses, as in Lehman Brothers collapse, or not be approved, just like with Greece recently. Let's sum up the presentation. We learned that stocks and bonds have been rising together. This is driven by yield chasing, and when it ends, they both will fall together as well. Fund managers pretend they're managing diversified investments. And if your retirement fund includes a large chunk of risky corporate bonds, you could be in for trouble in the coming downtrend. If you liked this episode, please subscribe to my YouTube channel videos.